The way real estate investing works is not you go out and buy a house to live in yourself. This is what most people think about. Instead, it's you going out and buying a house, buying an apartment complex, buying some sort of property, not for yourself, but to rent out to other people. And it can be very daunting, this idea of buying real estate for somebody else before you have real estate, but stick with me and see the different ways that you can do it, because for some people, maybe your first goal shouldn't be to buy a house to live in, it should be to buy a house to rent out to other people. That's personally what I did. I started investing in real estate to rent out to other people before I bought a house for myself. I did that for almost 15 years, that I was buying rental properties before I actually purchased a house for myself, because I knew that when I was buying this real estate to rent out, it would make me more money than if I bought a house for me to live in myself. Now, I don't recommend what I do to anybody else, but let me show you how real estate investing can be so powerful for the people that think differently. So if you go out and buy this house for $250,000, and I know what some of you are thinking, Jaspreet, where can you find a house for $250,000? Well, I'm based in Michigan. My office is in downtown Detroit. If you look around the Metro Detroit area, you can find some great houses just like this listed for sale for $250,000, which you will be able to rent out for right around $2,500 a month, which is pretty nice. Now, $2,500 a month in rental income sounds great, but you have to remember that's not all profit. When you purchase a house, you have expenses. You have to pay for the property taxes. You have to pay for the insurance. You have to pay for the maintenance. You have to pay for the management fees, because I don't want you to actively manage the properties, because remember, I want this to be as passive as possible for you. In the beginning, it's going to be a lot of work, but once you understand it and you build a good team, then it can be very passive for you, because I don't manage my rental portfolio. I have a team of managers that are doing all the work, and they just give me a report every single month of how things are doing. And then you have to cover the vacancies, because there's going to be times where tenants move out of the house and you don't have anybody paying you. So let's factor in some costs. I'm going to round up what I think the cost could be, because I'm not going to be upset if I made more money than what I expected, but if I make less money than what I expected, I'm going to be a little bit more stressed out. So when it comes to your property taxes, let's assume $250 a month in property taxes. Then you have to pay for your insurance, again, another $225 a month for your property insurance. Then you have to pay for your maintenance, and hopefully your maintenance costs are going to be less, but let's just assume about $250 a month factored in for your maintenance costs. Some months are going to have no maintenance costs, some months are going to have more. Then you have to pay for your management fees, because I don't want you managing this property yourself. A property manager might cost 8, 9, maybe 10% of the gross rent. So I'm gonna go with the 10% number. If you're making $2,500 a month in rent, your property manager might take up to $250 a month in management fees, and then you have to pay for vacancy costs. If your property is vacant for 1 month out of the year, well, that's going to be an additional $208 a month in lost rent. Again, it's not an actual fee that you're paying, but I want to factor in that cost, because most people forget that sometimes your property is vacant and you still have to pay for the expenses. Now, when you add up all these monthly expenses, what you'll see is that you are making about $15,800 a year in profit. And right now, I'm assuming that you don't have a mortgage, that you purchase this property all cash. Now, the first question you have to ask is this a good return or not? And this answer is going to depend on who you are and what your goals are. If you take this profit, $15,800, and you divide it by the amount of money you had to put in, $250,000, that's about a 6.3% cash flow. Now, the question is that good or bad? And again, it's going to depend on who you ask. For some people, they're going to say, that's an amazing return. I love the idea of getting a 6% return. For me personally, not good enough. I like to invest in properties that are paying me a minimum of 7% cash on cash returns. So it's almost there, but not exactly there. I like to look for every dollar that I invest, I get 7 cents of cash flow back. Now, the return that you're going to ask for is going to depend on a couple of factors. Number one is the type of properties that you're investing in, and number two, the location of where you're investing. If you're investing in Manhattan or Los Angeles or Miami or some of those really hot areas, you're probably not going to see these 7% returns. You're going to see 1% cash flow, maybe 2% cash flow, maybe even less, maybe even negative cash flow, because people are buying properties in these areas not caring if they make a profit from the rent. They just hope that these properties are going to be worth more money in the future. That's not the game that I play. I like to look for consistent positive cash flow, because again, my goal is cash flow. It's not to hope that these properties are worth more money. That's appreciation. That's not the game that I like to play, especially with my real estate. The second has to do with the type of properties, which also has to go hand in hand with the type of areas that you're investing in. In real estate, you have turnkey properties, and then you have value add properties. A turnkey property is a beautiful house, those cute little houses that come with cute little profits, but a cute little house is one of those houses that looks very nice. It has brand new flooring, brand new carpets, new paint on the walls, new landscaping, new everything, and it looks so beautiful. It's ready to go. It's where you want to live. And because it's already ready to go, you have to pay a premium for that, so your returns are generally going to be a little bit less. When it's an apartment complex, it is a property that's fully occupied, where everybody's already paying rent. It's a fully doing good property. It's turnkey. All you have to do is just walk in. A value-add deal is the opposite. You walk into this house and it smells like crap. There's holes in the walls. You walk into the kitchen and there's a rat running around. Those are the types of deals where you're going to get a big discount. And because you get a big discount, if you're willing to put in the work, you can get a better deal. I personally like these types of properties. With apartment complexes or commercial deals, this is where the property is pretty much fully vacant. And it's kind of a drug house right now. And nobody wants to be near this property. You're going to get a big discount on that property. It's going to be a lot more work, more risk, but you have the potential for more upside. These are the types of deals that I have found to give me better cash flow. More work, more risk, more potential return. Not for everybody, but it does work for the right person. Now, a few minutes ago, I told you that real estate is very powerful because it has some of the biggest and best tax breaks that our tax code has to offer. And so let me show you why this can be so powerful. Because when you go to invest in real estate and you make this $15,800 a year in income, you would think that you have to pay taxes on all $15,800 a year in income, which is not exactly true. For the purposes of this example, let's assume that in this $250,000 house, $50,000 was attributed to the value of the land and $200,000 was attributed to the value of the actual house, the actual building. Well, in the tax code, the United States tax code, what it says is when you go out and you buy a rental property that's a single family house, you get to take a depreciation deduction because your property has wear and tear, because it's 1 year older, you get to take a write-off because of that. And when it's a single family house, you find the value of the actual building, in this case $200,000 because we said $50,000 is the land, and then you divide that number by 27.5. Why 27.5? Well, that's just what the tax code says if it's a single family house. If it's a commercial building like an apartment complex, then you take that value of the building and divide it by 39. Again, that's just what the tax code said. I didn't make these numbers up. That's just what it tells you. So in this case, I take $200,000 divided by 27.5, and what it tells me is I'm going to get a $7,200 deduction. Why? Because of depreciation. Why do I get it? Because that's what the IRS tax code says. When you go out and you buy a single family house, take the value of the building, divide it by 27.5, and that's how much of a write-off you get every year for the next 27 years. So I made $15,800. This is how much money is in the bank. I get to take a $7,200 write-off, which means I have a taxable income of $8,600. This is how much money I'm going to actually pay taxes on, even though this is how much money I have in the bank. This is one of the hacks that real estate investors have to pay less money in taxes legally, because the IRS tax code says that you get this depreciation deduction. Now, some investors are going to take this one step further. If you get a savvy accountant, what you can find out is you can do what's called accelerated depreciation. Here, the $7,200 depreciation deduction is the base case. This is what the IRS just gives you. But what the IRS also says is if you can accelerate the depreciation, you can take a bigger deduction in year 1 and year 2 and year 3. So what some investors will do is they'll work with their accountant to say, value of the building is $200,000. In year 1, instead of taking a $7,200 deduction, we should take 10% of the property value, which in this case is $20,000, which means now you don't have $8,600 of taxable income, you have a negative taxable income of $4,200. Now, remember what I said just a second ago. This is not how much money you actually made. You have $15,800 in the bank. You just tell the IRS, hey, I have a loss. We lost $4,200 because of this depreciation deduction, because my property's 1 year older and we did this accelerated depreciation, which means you have $15,800 in the bank. You're going to pay $0 in taxes because in the IRS's eyes, you lost money. And then next year, when you go to file your taxes, you're going to take this loss and you're going to carry it forward to the next year. This is how many real estate investors get to make large sums of money and pay little to no money in taxes because of this depreciation deduction right here. And yes, you can qualify for this depreciation deduction even if your property is going up in value. If your property goes up in value from $250,000 to $500,000, you can still make this cash flow, have this money in the bank, and take this write-off, meaning have a tax break even though you're making more money. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.